I have a question though. I mean, is there really an alternative to printing all this money? Because if you look at the rate of debt creation over the past 30, almost 40 years, debt growth has exceeded GDP growth almost that entire time. There are projections that so many public pensions will be insolvent, that there's no mathematical way to make that possible. So is unlimited money printing just the easiest way to kind of softly default on that rather than causing some catastrophic collapse?
Well, or pushing into, or having to worry about a solution to it. I mean, yes, debt has increased over the last 30, 40 years relative to GDP, but it's accelerated by a lot. It's increased because it's had this sort of plaster over. So if the financial system, which kind of started this in 2008 was on the brink of what it said to be collapse, there were different ways that could have been addressed. One way would have been to let one or two extra banks collapse. And that really sounded harsh at the time. But throughout Wall Street, banks have collapsed. I mean, it's not like that hadn't happened. And the problem was there was so much attention focused on whether that was going to create a massive depression going forward that there was no conversation, or very limited conversation in Washington as to doing something else. You're, I'm sure, very mathy. The reality, I'll just go back for one little explanation of how I saw that, was at the time of the 2008 financial crisis, there was which was predicated on mortgage bonds and all the derivatives associated with them and all the credit and insurance that was traded between banks and all of that. There was only $500 billion worth of upset subprime mortgages in the market at the time, $500 billion, right? There was $14 trillion worth of toxic assets, that were reliant on those subprime mortgages paying their interest, and if they didn't get paid, would start to deteriorate in value. Banks lent to investors around the world, including pension funds, or helped pension funds, including municipalities, corporations, other financial entities, 10 times that. So $140 trillion effectively was on offer going after $500 billion of subprime-related assets. So that problem is what caused an acceleration of the production of artificial capital in order to solve what was really a major financial crisis. It was, but what could have been done is you could have just paid off $500 billion worth of subprime mortgages and forget whether that's an ideology of you're paying people who didn't deserve it or banks. It doesn't matter. The economics of it would have been far, far cheaper. Instead, the decision was made to plaster over that and to start this creation of 0% money so that banks would have the liquidity to start to, whoever was still left standing, to repay each other so that companies could repay some of the money they had borrowed that were still left standing that were involved in this. And as a result, it has created an extra level of capital in the system that makes debt accelerate, and it also makes stock levels go up artificially so that the next time there's a crisis, you're falling from a much higher height. So absolutely, they want that not to happen, which is why every single time a Fed chair says there's growth, there's inflation, this is you can trade this. I mean, if you're just even looking at this from an investment perspective, it's going to be followed by some major hiccup in the market, and then some other central banker, maybe the same one, or someone in their country saying, well, no, we didn't mean it. And that's exactly what the European Central Bank was talking about growth a minute ago. So was the Bank of England. They were going to be raising rates. All these rumors in the market, it put the pound up, and Brexit's fine. It's all going to be worked out. The central bank's going to raise rates. It's a sign of strength. It's going to help our currency into negotiations with Europe. There's all these sort of discussions and media narratives and politics going on back and forth. Reality is they don't have the growth, and the central bank head last week said, by the way, things aren't so great. They did not, well, they can raise rates on Thursday. They're not going to, I think, because actually the numbers don't bear them out, and also it hurt the market. And so, yes, you are right, long answer to your question, but the reality is they want to keep this going. They found a method to do it, and that just means that when things crack, they crack from a much higher height than they would have or even did during 2008.
So now we have 4.5 trillion in the market as money supply. And extra, exactly. I was wondering, how come inflation hasn't happened? Because all this money are in the banks.
That is such a good question, and different people ask that in different settings for, I think, different reasons. And I think that inflation has not risen on the sort of average generic way that inflation is considered and calculated because this money has inflated markets. This is inflation. The level, well, a third graph would, well, this and sort of the stock market. So it's kind of dipped a little bit, but it's sort of like that. And you have QE1, QE2, QE3, Europe, Japan, and so forth. That ultimately this 15 trillion and 21 trillion, if you add in all the other banks that are involved, and the market level, is pretty much the same. So there has been a tremendous amount of inflation. There's been inflation in the money supply, but it has gone into inflation of financial assets. It's gone into lining new debt. It's gone into inflating the value of stock because it's been an artificial source of money that's been used not just for stock buybacks, because that's kind of a one-to-one relationship, but all along the way. It's been there as a sort of security blanket for banks to be able to leverage more. Companies are leveraging more. Right now, actually, they're on average, companies in the S&P are leveraged more than they were before the financial crisis. So there's inflation, but it's not inflation of real prices. Where it had been for a while, for example, in Mexico, where they were reducing rates, it was inflating real prices because the relationship of that central bank and that monetary policy was more closely connected to the real economy. And the fact that we don't have inflation in these countries, because we don't, officially, but we have inflation in financial assets is a sign of how just sort of off the rails this has gone.
And my second question quickly, but also we used to have the gold standard, which would basically be something we could peg, right? The actual value of a dollar to. Today we don't have that, but we also have petrodollars, which are representing kind of an asset or resource that can be traded. Is that also why the dollar is still strong and we haven't lost the value of the dollar in the market, or is that completely unrelated to?
It's not entirely unrelated. The concept of the gold standard was something, or has been something, not returning to it exactly as it was pre-71, but returning to some sort of component of gold, say in the special drawing rights basket. So you have your 5 currencies and you have gold, and there's sort of an average. So you have something that's a real asset, or some sort of manner bringing back a version of the gold standard gets discussed. But for example, when the Chinese central bank was criticizing this Fed policy of just sort of inflating a sort of currency, but not having anything real behind it to back it, Ben Bernanke actually went on the defensive, and I have this in different parts of the book throughout the years, and started talking about how we don't want a gold standard. Like, it wasn't even brought up as a topic when he started defending it. And one of the reasons, or just throwing it away as a potential, and one of the reasons for that is you can't create gold. This is not to say that we should be on a full gold standard, or that it's actually a practical development, but having gold as a portion of a currency basket makes some sense because it's just an anchor. It's just something that's actually physically there, and it's physically, it doesn't retain the same kind of value the more there's other currencies and there's more speculation in the market that it might have if everything was going off of real trade and real hard asset. But it had an anchor level to it. And the fact that it isn't a part of the main system, but it is something that gets bought up by some of the countries, the emerging countries that are trying to trade with each other, their own currencies, as well as to try to have more of a portion of gold reserves in the potential that they create some sort of standard amongst themselves or something outside of the dollar, outside of the euro, is certainly something that has kind of been reinitiated in this whole process. Like, where that goes and how long it takes to get there, I don't know. I mean, there's people out there say the dollar's going to deflate tomorrow and gold's going to go sky high. I mean, I think there's a trend to gold being considered as something that should anchor this, and other countries using their currencies and trading with each other, like China and Russia, like Europe and Japan. There's a lot of trade agreements that have been developed and I have a lot of them in collusion, but that have been developed in these years amongst countries to try and offset some of the potential risk of really this policy. Not simply the dollar geopolitically, but really the policy of sort of bolstering a system that's not really restructured. and that has the potential to bring down an economy or multiple economies again. One alternative that comes up in questions is cryptocurrencies, and for similar reasons. And what's interesting is that though there's a lot of volatility in Bitcoin and other currencies, and there's a lot of risk in being involved in them. They're speculating in them, which has its own risk attached. But there's actually, if you're going to use them on a regular basis, that kind of volatility could, ruin anyone's business on any given day or pop it up. And that's not the kind of volatility in the real economy that most people can or should handle. But the idea of having alternatives, any alternatives to this system, is very much an accelerated concept because of how it's been handled, because nothing has really been reformed or fixed. It's just been plastered over by sort of this artificial part of the system. So the head of the IMF, Christine Lagarde, who, again, IMF, the International Monetary Fund, very much a part of the system, very much involved in the whole dollar European currency system from when it was created in the wake of World War II. And it was created to basically subsidize countries that were allies of the US and Europe. I mean, this is kind of part of the point. She currently has been on multiple public arenas talking about alternative currencies and how cryptocurrency is something that is happening and it's expanding and they need to be aware of it. There are full SWAT teams at the Federal Reserve now that are doing that sort of under the radar. And there's also, you can get jobs at the European Central Bank right now that are listed to be involved in developing technology related to cryptocurrency analysis and so forth right now. So they're definitely all involved from a different perspective. But the idea of it sort of, of who actually ultimately gets the sort of regulation of it versus the use of it, I think is still up for grabs, because if you had cryptos created by the same central banks that are creating this currency, then you don't necessarily gain sort of autonomy from this system by doing that. But if there are cryptos that are regulated by a portion of this so that they're not as sort of volatile for end users, then they actually might spread that much more quickly.
I'll ask a follow-up question to that. I've kind of just as a dabbler in cryptocurrency, people always ask, but what is it based on? And the answer is, well, not much, but it does have a fixed supply. Thinking just the original Bitcoin, like 21 million coins. Well, gold is a fixed supply. So when I look at those, I think one of the arguments is, well, sure, Bitcoin is volatile, but if nobody's on the gold standard, it doesn't matter either. It's kind of an odd, magical thing to me of how people decide to buy into agreeing to stick with a fixed supply of anything when it comes to, I guess I would say, a game this big. What would be the motive? Would it just be looking for something stable, and what would bring this air balloon back down, I guess?
I think the idea, and it's slightly different